There will be an event, a black swan event. It could be a pandemic, it could be a war. Something will happen and people will say, you know what, I don't trust the dollar, or I don't trust holding treasuries.
That's the part we forget, that we think there's going to be a warning, that there's going to be signs, and then we can prepare and we'll have time to prepare.
Obviously, a collapse of the euro, if it happens, would be a very serious thing globally. The collapse of the euro would mean every country starts to go its own way.
So what does that mean for the people of Europe?
It's a bit like everywhere on the planet. You need to hold assets in something other than the fiat currency. What will cause the gold price to ignite? The answer to that is
we are talking debt bombs today. The premise that when something cannot continue forever, it doesn't. So the question is, how close is the U.S. economy from exploding, from popping? Let's take a deep dive into its debt issues today. And joining me to do this is Clive Thompson. He's a retired managing director for Union Bancaire Privée in Switzerland. He joins us just outside of Geneva today. Clive, always good to see you. Welcome back to the Daniela Cambone show.
Daniela, thank you very much for having me on your show. I'm very honored to be invited.
Well, I follow your work closely, Clive, and I thought it's a really important time to bring you on because here in America, there is a lot of hopium right now that with the new administration come January 2025, a lot of economic woes will disappear. I read with great interest one of your latest pennings where you really do a deep dive on the debt bomb that's ticking here in the United States. Basically, you talk about the debt growing faster than the economy as the interest rate burden will also increase. It's a debt bomb waiting to go pop, you say. Increasing government debt can only continue as long as billionaires, pension funds, and foreign governments continue thinking lending money to the government is a good idea. Clive, my mission for you today is to paint us a picture of the current situation in the United States. Can a magic wand miraculously make this debt go away? What are we looking at? What are we facing?
Well, Daniela, let me start by asking you a question. I'm a very credit-worthy person. Would you lend me a small amount of money?
I trust you, Clive, so yes.
Now, what if I told you that my credit card debt is so large that it exceeds my annual income and the interest payments, because I can't stop spending more and more, are very soon going to exceed my annual salary? Would you then lend me money?
Well, I would still give it to you because I feel bad for you.
That's okay. Well, a lot of people feel that way about the United States, I think.
Right.
But that's the kind of situation we're in. And it's not just. By the way, I'm not picking on the States here. It's a global situation. Since the 2008 debt crisis and since COVID, governments have got in the habit of spending a lot more money than they can collect in taxes, and that's called a budget deficit. And when you run a deficit, you have to not only renew your existing debt, but you also have to finance that new debt at today's higher interest rates. They're a lot higher than they were 5 or 10 years ago. Don't forget, 5 or 10 years ago, around the world, we had interest rates effectively at zero. A little bit more than that if you're borrowing for 5 or 10 years. But when governments borrowed money, they were paying much closer to zero than the rates today. So governments are having to refresh their debt. That's the maturing debt, the money they borrowed 5 or 10 years ago, which comes to maturity now. They're having to refresh it at a much higher interest rate. We're talking about 4-point-something% than it was 5 years ago when it would have been 1%, something like that. So the problem is the interest on a debt burden, which is considerably higher than it was a decade ago, is now rising for two reasons. One, because they're renewing that old debt as it matures at a much higher rate than ever before. And secondly, because they have a budget deficit, which is bigger than it ever has been in history. And they're having to borrow that extra money on top of what they're renewing, also at the higher rates. So the consequence of that is that the interest on the national debt is starting to rise fairly rapidly, and it's going to keep rising. And if we look at the statistics put out by the Congressional Budget Office, their own forecast, this is the government's forecasts, we can see that debt burden rising. And it's going. Currently, we're at the debt is at 100%, and the interest being paid on the debt is about 14%, up from 7% a year or two ago. That interest is going to keep rising, and the level of debt as a percentage of the economy or a percentage of GDP is going to keep rising. So, as the Congressional Budget Office sees it, currently we're at a debt to GDP ratio of 100%. It's more than that if you take into account the Federal Reserve's borrowing and things like that. But if you take the debt owned by the public, we're at around 100%. They see that moving up towards 200% and beyond. And of course, with that, at interest rates, which they're forecasting are well below today's rates, the interest is going to keep spiraling up and up and up. They haven't put their figures out for sufficiently far in the future, but it's quite clear if you follow the trend, the interest is going to exceed the total of the US government's tax take at some point. So certainly by the time any child who's born today is in his 30s, the real debt will be more than double what it is today, and the interest being paid on that debt is probably going to be 4 or 5 times what it is today. So that interest will be consuming a huge percentage of what the government is taking in taxes. There comes a point where people say, you know what, I'm not so sure that if I lend money to the government, that when they repay me in 5 or 10 or 20 or 30 years' time, that what I will get back will actually buy me the kinds of things I'm going to want to buy in 5, 10, 20 or 30 years' time. Now, I'm not so much talking about the retail or consumer price index, which measures the prices of things which are mass-produced. Now, a lot of things which are mass-produced are made by robots. So the labor component, which is the variable component which goes in there, and the material costs, they're not that a bigger component. So retail prices won't be rising by as fast as the level of debt rises. But the kinds of things you might want to buy when you retire, which are the luxuries of life, the rarer things, perhaps holidays, perhaps paintings, perhaps you might want to employ people to look after you in your old age. That's a rare commodity, people who look after you. Those things are all going to cost an awful lot more in real terms than they cost today. And that's because the inflation rate of those things will be rising much faster than the retail price index, the consumer price index, for the simple reason that they're in short supply, they're not produced by robots, and the amount of money on the planet and the wealth on the planet will have increased a lot. Let me just explain that a lot of people say we only look at the money supply to judge how prices should be rising, but you also have to look at government debt. You see, when the government borrows money, the government gets poorer. It goes deeper and deeper into debt. But the consequence of it going deeper and deeper into debt is that it spends that money on somebody somewhere. In fact, it spends it on everybody, with social security, benefits, roads, transport, police. Doesn't matter what they spend it on, they're spending it. Always that money then tends to gravitate to the richer part of the community, those people who are mostly those who are in retirement and have accumulated wealth over their lifetime and now need to spend it on care in their old age, on their holidays. Perhaps they want to buy themselves a nicer home. Perhaps they want to have nice paintings on the wall. Those kind of things, the supply of those will not have risen, but the amount of money they hold to buy those things will have risen substantially. And Daniel, I know you're a fan of gold, and gold will be participating in this rise every bit as much as all the other things I mentioned.
And I want to talk more about that because, as you say, we've passed the point of no return and this will ignite gold. So I want to get back to gold. But just to kind of wrap this discussion on the debt before we move on to so many other news points I want to get to, we've seemed to have become desensitized to the debt numbers.
Yeah.
And the pushback I get is, well, we've been talking about the debt for decades. It never becomes a problem. Like I said, desensitized to the numbers. What's another trillion? What's the magic number, Clive, that at one point you can't just keep accumulating this debt?
There isn't a magic number, but the moment when it all comes to a grinding halt will come without warning. There won't be any warning. There will be an event, a black swan event. It could be a pandemic, it could be a war, it could be a recession, it could be a natural disaster, it could be a political crisis, it could be civil unrest. We don't know what the event will be, but events happen. At some point, something is going to happen. It could be something happening a long way from the United States in an overseas country. Something will happen, and people will say, you know what? I don't trust the dollar, or I don't trust holding treasuries, or if it's, it could be saying about the UK, because don't forget the debt bomb is not unique to the United States. It's a global thing. The United Kingdom is a study I did in the same study, and they are also in exactly the same situation. People, by the time they're in their 30s in the UK and the USA, will be looking at huge multiples of debt burden, government debt burden, compared with where we are today. So a magic number, there isn't a magic. There's no magic number. It might be tomorrow. I don't think it will be, but we could go into a crisis very suddenly without warning.
I'm so happy you said that, because I think that's the part we forget. That we think there's going to be a warning, that there's going to be signs, and then we can prepare and we'll have time to prepare. So that's such a key point, I think, especially in the context today of what I was saying of, everything's going to be okay, that many will just get blindsided, Clive.
Yeah, I mean, go through history and look at the events that happened, which we never saw coming. You can take 9/11 as an example, but the one which will always stick in my mind is the 1987 stock market crash, when stock markets dropped by 30% in a single day. And it was a culmination of a lot of things, the algorithmic trading by computers, which were sort of just getting started, trading the futures against the stocks. There was the hurricane in the UK, which shut down the entire stock market of the UK on the Monday for an entire day. And the orders were piling up from all around the world, with everybody trying to get their sell orders in before New York opened. But there was nobody in London to take those orders. And around the world, stock markets crashed by 30%. Nobody saw that coming. Nobody actually, I mean, even the weatherman on the TV the night before the hurricane was asked, is this going to be a hurricane? He said, no, nothing to worry about, really.
Apparently, a woman rang the BBC and said she heard that there was a hurricane on the way. Well, if you're watching, don't worry, there isn't. But having said that, actually, the weather will become very windy.
It was a hurricane which literally wiped out all the railway lines, all the roads into London, and of course nobody was in the stock exchange, nobody was in the broker houses, and yet the fax machines were still buzzing with faxes arriving from Asia saying, sell everything before America opens.
Yeah, that's and then so one day we could wake up and all the cash in our banks could be worth absolutely zero.
Well, I don't think that's necessarily going to happen like that. But obviously, it is a risk. But we have seen what happened in 2008. The government did step in and save the banks. So the realistic assumption, they'll do it next time. But if they do that, of course, that will mean another surge in printing of money, which is going to be inflationary for tangible assets that people desire, which are in limited supply.
You said before this phrase that made me think of the next question I want to bring up of, countries saying, you know what, I don't trust the dollar. We're seeing glimpses of what the future administration plans to do for countries that want to move away from the dollar. President-elect Donald Trump just last week, and as you know, Clive, issued a stern warning to the BRICS, like, don't even think about it. If you're thinking about moving away from the US dollar, you're going to get 100% tariffs. What do you think of warnings? Is it genius or desperate?
First of all, I think
or
the
neither.
warnings. I'm going to say neither. I think the warnings are just words which are pandering to the public. And secondly, from the other side, the BRICS, I don't really think they're going to move away from the dollar that much. Of course, they want to move towards an alternative system so they don't have to rely on the dollar, but that just means put in place the alternative system just in case. I think they're still going to use the dollar, but there will be over time a gradual shift away from the dollar. You know, I think we are at peak dollar, and I think that the dollar's dominance will decline. But it's not something which is going to happen overnight. It will take decades to happen. But you know what I think is going on is one, the dollar has been weaponized, and countries want and need to have alternative methods to settle transactions between themselves. And secondly, with the failure to address the level of national debt, governments who have been holding US treasuries as part of their reserves must be weighing up whether they need to have a better diversification. And the fact is we're seeing that happen because we've seen the exposure to gold around the world in central banks increasing at the same time as the exposure to government debt is decreasing.
Absolutely. Well, we just saw Poland upping their gold reserves. So central banks, as you say, keep buying gold. And I want to get back to that. But one more point, you know, talking about possible black swan events. Let's talk about what we're seeing in Europe as we're speaking, the French government facing potential shutdown, and we'll see what happens there. But bigger picture is France and Germany. The political crises and weakening global demand have hit the growth prospects of the EU's top two economies. This is according to the OECD. Let's talk about if France were to fall, right, and Germany, and their economies faltering, the domino effect this could have on the euro as a whole. Your prognosis, your forecast on the EU, Clive.
Well, you know, France was a basket case before we went into the euro.
Correct.
And it looks like it's a basket case again. Whether they'll come out of it or not, I mean, I think the Prime Minister will resign in due course. But obviously, a collapse of the euro, if it happens, would be a very serious thing globally. There'd be quite a lot of chaos, and that the collapse of the euro would mean every country starts to go its own way, and we have all different countries in Europe pulling in different directions in their own way. And you know, if you think back as to what nearly happened in 2008 and 2012 and 2015 with some European countries, they call them the pigs, the Portugal, Italy, Greece, Spain, and I think Ireland was in there for part of the time as well. You know, it looked very much like Europe was going to come to an end, and then of course they engaged in some emergency actions, screwing the private investors over to to save the European Central Bank. So you know, investors in government bonds must not expect to be saved if an emergency occurs. They will save the ECB first, the European Central Bank, to try and save the system. So that's my message. You do exactly the same thing will happen as happened in 2012. They will not save the private investors if they have to try and save the euro.
Wow. So what does that mean for the people of Europe?
Well, you know, it's a bit like everywhere on the planet. You need to hold assets in something other than the fiat currency. You don't want to be holding bonds, which are also fiat denominated, especially not government bonds. They have a very low rate of interest. I mean, just to sort of illustrate the way people see things going, we've seen a plunge in the interest rate on Swiss franc 10 and 30-year bonds.
Yeah.
And why is that happening? Well, everybody on the planet's saying I don't want to own any of these European bonds. Switzerland's not in the euro. Switzerland balances its budget. I'll stick with a country which has forever had a sound currency, and also so they're quite happy to earn 0.2% on a 30-year bond, where they could have had 3 times, 10 times that in euros. Why is that? Well, it's a question of trust. On the one hand, although your 20 basis points on a Swiss franc bond isn't paying the fees to manage that, you'd rather have that slightly negative return than the positive return of a few percent on a bond issued by France, 2.5%, whatever it is, because you're not sure you're going to get paid in something which is valuable 5 years from now.
So let's talk more about that, the rush into safe havens. And going back to my point of how there's this feeling of, a better sense of the economy, we're not seeing that rush of retail investors turning to gold, seen as a safe haven right now. Yet on the flip side, central banks are still buying gold. And I always say you should look at what they're doing and not saying. What would ignite the rally in gold then if retail investors are still asleep on the concept?
Yeah. So currently we have very little investor interest in gold generally.
Yeah.
It's starting a little bit to grow amongst the investment management firms, like the big banks, who are now starting to, in some cases, put gold as their preferred asset class or have a small percentage exposure. The reason we know there's very little interest in gold is when you look at the gold ETFs, there's been very little flow recently into the gold ETFs. Yet there's massive flows into the S&P 500 ETF and other mutual funds and equity funds. So what's happening is, for the last decade, we've had a strong rally in the stock market, several 100%, and it continues. Yet at the same time, gold has done almost nothing. It is up 20, 30, 40% this year, but that's still relative to what the stock market's done over the last decade, nothing. It's a complete contrast to the decade before that, from the year 2000 to about 2010 or 11, when gold went up several 100% and the stock market, the S&P 500, went down in the decade. So we had a decade when gold was rising from 2000 and stock market was falling. Then we had a decade when gold, up until a year or two ago, did nothing, and stocks were rising strongly, and stocks continue to rise strongly. But of course, we now got the gold starting to move. It's right at the beginning of what could be a very, very long-term move. It's up 30 or 40%. That's really absolutely nothing compared with the hundreds of percent that it did in the decade before, and probably will do again. So people are still chasing the horse which has been winning for the longest time, which is the stock market. And in particular, they're throwing money, maybe not directly into the Nvidias, Microsofts, Apples, Netflix of this world, because a lot of people do sort of see that they've become overvalued. So what they're doing, they're going to their banks or their advisors and saying, what can I buy? I've been missing out on this huge bull market. I feel frustrated that I didn't catch Nvidia, and maybe it's too late to buy it. What shall I do? And the advisor says, well, I've got this really good fund for you. Look, it's performed XYZ% a year for decades. It's a great fund, or this ETF maybe. And they say, all right, that's great. I like good management. I'll buy that. What they don't necessarily appreciate, the reason these funds have had such good performance is because they own exactly the same stocks that these people feel a little bit nervous about buying at the higher prices. Now, I'm not about to tell you that the stock market's going to crash, because we're in a phase where there's a huge amount of money being created due to the government borrowing, and that money has got to find its way somewhere. And the nature of people is they're buying these funds, not looking at what they're buying, but when the money goes into an ETF or when it goes into a mutual fund, those funds have no choice but to increase their exposure to these large cap companies, which are, relative to the rest of the stocks in the index, rather expensive. I mean, it's like, you're a lady. Imagine you're walking down the high street and you see a beautiful dress in the street. You'd really like to have it. Now, if that dress is priced at $10,000, you're probably going to think twice before buying it. But if you see it priced at $100 or $150, you're going to think, I'll have one of those. I like it. Unfortunately, most investors don't have that ability to look at stocks in the way they'd look at the dress. All they see is the stock market's been going up for decades or for years. It's a great investment. I want to have part of it. And the way I get part of it, because I'm not good enough to pick the individual stocks, I'll buy a fund, which has done well, and the fund has no choice but to buy that $10,000 dress. So that's, I think, what's going on. So what will cause the gold price to ignite? So the answer to that is when this rally in these exciting stocks comes to an end. I don't know when that is. If I could tell you a day, I wouldn't be sitting here talking to you, Daniela. I'd be super rich. But I do know that I'd rather be early in the gold. And I have, just to tell you factually, I haven't sold every single one of my technology stocks, but I'm much, much lower than I was a year ago.
Wow. You really made your point. You really, really just drove home that point, Clive. And I hope we'd still be speaking even if you were a zillionaire and you wouldn't forget about me. Why do you say stop trading Bitcoin?
It wasn't that I think people should be not buying it or not selling it. It's a different way of thinking. The point was, if you own it already, hang on to it for dear life. And why do I say that? It's because the administration in the United States, which is the biggest relative market for where the price of Bitcoin can go, the administration is changing towards a pro-Bitcoin stance.
Big time.
Future President Trump is appointing two key positions individuals who are pro-Bitcoin. And the result of that is that the trend that we have seen over the last few years, where the forces of the powers and be have been working to maybe suppress the price of Bitcoin, stop people owning it. Those are being removed to some extent, or will be removed. For example, Gary Gensler has said, I will resign on 20th of January. And Gary Gensler was a big opponent to anything crypto related. Why is he resigning on the 20th of January? Because Trump has said, I'll fire him. So hopefully we'll get a person in his place who's going to be much more crypto friendly, who will probably drop some of the cases that are being made against the various cryptocurrencies. Now, I don't want to talk about cryptocurrencies because that's not my bag, but I do think Bitcoin is the important one to look at.
But how does, given that, the context of the pro-Bitcoin administration, what impact does that, if any, have on gold?
I really think they're two different things. I think there's many people around the world who like to hold both. And the reason they like to hold both is because it makes sense to have several asset classes in your portfolio. The more asset classes you have in your portfolio, the less volatility your portfolio is likely to have. Of course, it's all to do with proportion. Now, if you put 95% Bitcoin and only 5% stocks, you're going to have a huge amount of volatility. But if you have a few percent of Bitcoin, 2-5%, something like that, I don't want to say a specific number, and some gold, and some equities, and some property, and some other things like alternative investments, you'll be having a smoother ride. It won't be straight up anyway, but you'll have a smoother ride than those people who have 100% in something.
Clive, one more point I wanted to get in here. Obviously, you're an expert when it comes to the banking system. That is your wheelhouse. And I know the last time we spoke about possibility of bank runs, I just want to return on this subject because I actually had a really good talk with Jim Rickards, who just did a whole book, focused around AI. And his thesis is that with AI, we can actually see an acceleration of bank runs, that when they happen, it's not going to happen over a series of days, but it would happen overnight. Your thoughts, I'm just wondering if you have any thoughts around that, on AI, on bank runs, on the
well,
health of the system?
When Washington Mutual went bust more than a decade ago, people had to go down to the bank, fill in a form, and ask the bank to wire their money somewhere else. So it took about 16 days of bank run before it finally closed its doors, because people were having people couldn't do it the way they do it today. Now, the biggest enemy this year of banks is the mouse. Why? It's because the information and the rumor can move at the speed of light, and when it moves at the speed of light, the individual who owns the mouse can move the money at the speed of light. But what you're talking about here is the AI, because that is the next generation, because it won't be a man sitting with his finger on the mouse. The AI will read the rumors, read the stories, make its assessment, and move the money before anyone knows it's happened. So it can happen. Money can move very, very fast. And that means that if a bank is in a situation where it has lent long, it has long term, it's lent out mortgages for 30 years, 20 years, 10 years, and it's got other assets which won't be repaid because they lent them to commercial companies, and those companies aren't going to repay tomorrow, yet a large enough percentage of depositors click the mouse, or in the future world, the AI clicks the mouse for them and moves that money, they suddenly find they've got a huge demand for money that they don't have. And they're going to have to move at the speed of light to get that money from somewhere. And the obvious place to get it from is the Federal Reserve. But of course, the Federal Reserve isn't necessarily going to bail out every bank which comes running to it saying, hey, we've got a problem. Please, would you give us a bunch of cash in return for these assets which you won't get repaid on in 30 years? It might not.
It will be there for JP Morgan.
Of course, because we've got this concept of too big to fail. So, I'm not worried. I don't think we have a wholesale, another way, we could have a wholesale banking crisis. And we could have a situation where some people do not get bailed out because the Federal Deposit Insurance Corporation and similar organizations don't have enough money to bail out more than a very tiny, tiny, tiny percentage of what it's guaranteeing. But that's like all insurance companies. They don't expect all disasters to happen on the same day. But if you have too many disasters, the insurance company goes bust, as would the Federal Deposit Insurance Company, and then we'll see what happens. But for the big boys, I think the big boys, at the end of the day, they'll try and save the banking system if that happens. But the way you save a banking system is to do exactly what you did in 2008. Either you print a ton of money and give it to the banks, or the government borrows a ton of money from the Fed and gives it to the banks. What does that mean? It's inflationary.
It always comes back to that. Clive Thompson, I love speaking with you. I really, really, really do. Come back soon.
Thank you, Daniela. And I hope your viewers enjoy this, and thumbs up for all of them and for you.
Thank you very much. Happy holidays. Merry Christmas to you, Clive.
Thank you. Merry Christmas to everybody.
And we will continue bringing you, all my incredible, beautiful viewers, great content, great conversations like the one we just had with Clive. So be sure to sign up at danielacambone.com so you stay on top of it all. And of course, subscribe to our YouTube channel. We are keeping you in check. We don't want you to get blindsided. Keep watching. We'll see you soon. Gold prices are now back up after taking a breather following the win from President-elect Trump. Many thinking, well, now that there's euphoria back in the markets, maybe now is not the time I should be buying gold. Well, I'm here to tell you that if you track history,
it will prove time and time again that the longer you wait, the more you will generally pay for your goals. So that's why I urge you all to reach out to one of my colleagues at ITM Trading via a Calendly link. You can find that below in video, and they will walk you through all the fundamentals and the main pillars, the reasons you should be owning gold today. Do it now.